Good afternoon. Welcome to my pre-class video series for Intermediate Financial Accounting 2. What we're going to look at is we're going to take a look at this afternoon pensions, chapter 19 in our textbook. I'm going to get you started with pensions. I'm going to get you started with understanding why we're creating a schedule, how to create the schedule, get started with some of the easier items. Have a look at this, listen to the video, try doing this again on your own, and when you come to class, it'll make the transition to the remaining portion of the lecture easier for you. Are you ready? Let's get started. When it comes to pensions, what we have to do is we have to use a schedule. We're going to have a lot of information. We put that information into our schedule, and it'll allow us to do our journal entry that we need to do. Now, where do we start? Well, this is a continuity schedule. Means that it has a life and it continues on year after year. So we're going to start with opening balances. And we're going to have balances that existed from a previous year. And we have that information over here. So imagine a company that's organizing a pension on behalf of their employees, and the trustee is holding all the assets for the employees so that when they retire, the trustee will pay the pension amounts to the employee. So over time, assets accumulate. So we're going to have $10 million of plan assets. Now, how do we record assets? Well, with a debit. So this is going to be $10 million debit. So we're going to use debits and credits to understand our balances. Now, of course, we have liabilities, an obligation. So when people work for us year after year, we're obligated to fund their pension. We're obligated to put those monies to the trustee so that the monies will be there for them when they retire. So that creates an accrued benefit obligation. So at this point in time, that obligation, measured by an actuarial, is 11 million. So what you can see now is that we've got $11 million as a liability, $10 million as an asset. That difference creates a liability for us of $1 million. So this is a common theme, and a challenge that we have around the world, especially here in Canada, is that our pension funds are underfunded based on what we project to be owing. So the actuary provides us with a projection. We have these assets, and in this case, and as in most cases, we are underfunded. So what you can see here is that when you take a look at it, we've got a $1 million shortfall. So that starts us off by recognizing that we now have a $1 million liability. And you'll see that debits don't equal credits. And this is the only time that that happens, is in the balances, because there is a difference here. This, a great way to look at it, is your balance sheet. And that basically this balance sheet is showing is that we are short $1 million. Now, going forward, all the entries we put in here, debits must equal credits, just like we use in accounting. So that's a key thing, understanding that debits must equal credits except for our ending balances. And our ending balances, there's going to be the difference between those two, and most of the time representing a liability. If this is a debit, a positive, then we'd actually be very happy. But that's usually not very likely. So we've got three items here. Pretty straightforward items that we need to start into our schedule. And this is basically, again, helping us get started understanding the schedule. And when we come into class, I will go through the more challenging entries for our schedule. So here's our first one, current service cost. So current service cost. And that is $125,000. So how do we complete our schedule with that? Well, right off the bat, it's a $125,000 increase to our liability because that's this year's increase in our liabilities for our pensions. That's the obligation. And again, over here, because debits must equal credits, we're going to put the debit. And this is our pension expense for the year. So what you can see here is that in many ways, this section right over here, and you can draw a little line down here, this is all about helping us come up with our journal entry. Over here, this is helping us come up with our ending balances. And again, what you're seeing now, debits equal credits. So what you need to do as a student is initially you got to understand where these amounts go on the schedule. Here's the next one. Contributions made. Maybe the employer made the contributions, maybe the employees made the contributions, or maybe both made the contributions. Contributions would be given to the trustee. So in this case, cash would be given out. So $85,000 credit, you're giving out cash. But in this case as well, $85,000 would then be given to the trustee, which would increase our assets. Now, people have retired. People are receiving benefits. So another line item here is benefits paid out. And again, the trustee would be the one paying these to the people who have retired. So what you could see here is that $60,000 would be paid out. So now that's a credit. So if you were to add and come up with the total of this column, you would add this number to this number, subtract out that number. Add your two debits, subtract out your credits. And we would be reducing our liability, which is a debit then, because we reduced our liability because we paid the people who are retired. So again, if you were to total this column, add the two credits, subtract out the debit. So when you're doing the summaries and you're summing up the totals, you sum up the totals with the credits and the debits, of course, being separate. So I hope this helps. Hope this gives you a great start to this topic. And when you come to class, we'll complete the rest of the schedule, and I'll spend some more time with you going over this and then introducing a little bit more of the challenging calculations. Everybody, have a good day.